How's it going, everyone? It's Sam. Today I'm going to be showing you something that I usually just show the Patreon, and I usually talk about it with them about once every month or two. But I'm going to be going through my entire stock portfolio, what I've been adding to, my thoughts on every single company I own, and I'm going to be showing you the exact amount that I own in terms of weighting in my portfolio. Now, I'm not going to show you the actual numbers just because sometimes I talk about how much crypto I have versus stocks, and I don't want you to be able to pull back how much crypto I have just because that is a totally different beast, and I'm just a little bit cautious about that now. But I want to go through it. If you want to get this information more regularly and see what I'm buying on a daily basis, you can actually go join the Patreon right underneath the video, and there I tell everyone exactly what I buy every single day in crypto and in stocks, options, opportunities as well, and I also give market updates and exclusive videos. So check that out underneath the video. If you want to know some of the apps I use for this, I use Fidelity and I use Webull and M1 Finance. Both of those are underneath the video where you can get some free stocks or some free money for signing up and depositing. I'm not going to keep you here to the end by doing my biggest position last. I'm going to do the biggest position and then go through each one. But also there are some positions towards the end that I definitely want to add more to because I think they're at a good value. So I appreciate it, and let's take a look at how this is broken down. So this is one of my top holdings, Tesla. Let's see. You have to remember, I don't change this every day. It's not like I have it in all in M1 Finance to rebalance regularly. So I've been adding to certain positions, but just depending on how the price moves, it can change the weighting in my portfolio a lot because I've been dollar cost averaging for years now into some of these names. So Tesla's my largest weighting right now at about 27%. I wouldn't mind this going down a little bit. I love Tesla. The problem is that it seems like such a good deal right now that I've had a hard time not wanting to add to it. I would like my portfolio to shift a little bit to more solid, kind of boring, really consistently growing companies, which Tesla is just a growth beast. And I see too much opportunity in it to not be averaging in right now. And I don't even consider taking profits right now, which is a big part of it. Right now it's 530 billion. Of course, it is expensive when you look at the free cash flow yield. So right now, over the last 12 months, we've had about $7.5 billion in cash flow. And if you go down here, you can see a lot of money is going to CapEx. That's a large part of why they haven't been even more profitable on a cash flow basis, because free cash flow takes out CapEx. But you can see that they've really slowed down the dilution in shares. And actually, if we go to free cash flow or stock-based compensation, stock-based compensation has actually gone down from 2021 to 2022, which is pretty important because this basically dilutes shareholders. They've also talked about a stock buyback, which they haven't gone through and actually done yet, but that does make it really attractive when you look at it for the long term, because they are going to start returning capital to shareholders in other ways than just reinvesting in their business. So right now, obviously, like we said, they have a lot of free cash flow, 7.5 billion, but they're also putting a lot of money into CapEx. 7 billion plus. They spend 3 billion on R&D, which has been pretty consistent. They've been investing a little bit more each year, but last year they invested 2.6 billion, this year 3.1. So it's not growing as quickly as their revenue, and it's also not growing as much as their free cash flow. It basically doubled. I think they're going to be extremely profitable over the coming years. Their energy business is growing. They are in a tight spot right now because people don't want to buy cars when there's a looming recession. So I understand why their business is in a tough place. But when you look at all their metrics, they're all really impressive. I mean, they're adding cash. They're paying off debt. They went from $3.4 billion of debt in 2021 to basically zero debt in 2022. As of last quarter, let's see. Yeah, $1.3 billion worth of debt. So basically nothing. And they have so much growth happening. They're reinvesting in their business and getting really high returns on capital employed, so they're able to actually consistently reinvest in their business and get more and more out of or more and more EBITDA growth and free cash flow growth, earnings per share, that kind of thing. So I really like this company. I won't spend any more time on it. I mean, everyone that likes Tesla probably likes Tesla and will continue to like Tesla. Everyone that hates Tesla will probably continue to hate Tesla. It is at a 29 forward PE, so they are getting more profitable. There was a point where it was at 20, which was just a bargain steal. I think 30 is a really good deal too for the long term. When you look at their EPS growth, right? Basically doubling in 2022. If they hold steady this year and they don't really grow, but then they double the year after, people will be thinking this is a steal, because that would basically be a forward price to earnings ratio of 14. So like 2 years out of price to earnings of 14, which is a great deal in my opinion, assuming you think they're going to keep on growing and continue to get market share. That's a main problem that most people have with it, is they think it's just a car company, and that means that they're going to have to lower their margins, which they have been doing recently to sell more cars, and they're going to have to continuously lower the margins. The other side is you think that they're a growing tech business that has a lot of energy products. They have a growing fleet of cars that are getting more and more data all the time, so they will eventually be able to transfer that into some product that they can continue to sell and make that ecosystem a lot stronger. Something like full self-driving, then your home storage business or home energy storage, solar roof, that kind of thing. And they have a lot of other parts of their business as well, like with robots, if you want to get into that, and their Megapack business. So they have a lot of avenues of growth, if you include Tesla insurance too. So I could go on and on about Tesla forever, but let's move on. Google, 25% of the portfolio. A lot of this is just due to the fact that I did pick up a lot when it fell. I picked up a lot of Google and Amazon when they fell into the low 80s. Since that time, they're up about 35%. Now, I was adding a lot before that too. I've been basically dollar cost averaging into this very heavily for a year and a half now. And they just have really steady revenue growth. They have had some scares recently with AI. The free cash flow actually went down, which we haven't seen since 2017, 2018. It went down in 2022. I think there is some pull forward, basically, with their business over the last couple years since 2021. A lot of people were using Engine. A lot of people were using YouTube. And right now, going into recession, there are a couple fears, basically. One, advertisers aren't paying as much. Two, they could be thrown off by Microsoft with their AI business, because that is shaking up the search industry a lot. And then three, we have to realize too that less companies are going to be looking for cloud providers. Now, this was an important quarter because they had their first profitable quarter for cloud. And you can see it's still such a great company. I mean, the return on capital employed 6%. That's fantastic. Over a quarter. The kind of the number to look for is about 8%. That would be about the break-even point of return on capital employed. To give you about a 12 PE ratio over the last year, they're at 25%, so that's pretty good, really good. The R&D is going up to $40 billion, so they are spending a lot at their business. I think their long-term bets or their other bets, the part of their business that they just shovel money into, it's kind of a dying business, or not dying business. It's just kind of a leech. It's just sucking blood from the rest of the company. I would love to see if they just put that into buybacks or a dividend, and not even the whole thing, but just cut down on it. I'm guessing there's a lot of waste. They still have a lot of employees, 190,000 as of last quarter, and they had about 160,000 the year before. So still growing a lot of employees, but they said that doesn't necessarily represent what they've done recently with firing some employees. So we'll have to see in the next quarterly report how that all shakes out and how many employees they actually cut. You can see stock-based compensation does account for a lot of, or does take up a lot of the free cash flow, 60 billion versus 19.3. So they are diluting shareholders with some of the stock-based compensation, but this should probably tick down next quarter. I think YouTube's going to continue to grow, but again, a lot of people were just watching it during COVID. A lot of people are going out now. I think their search business will continue to grow. It sounds like they have a really good AI product that's not barred, but they're putting it on the back burner. They're not showing it yet. So I think that will be really interesting and could push up the stock a lot. Now, personally, I have a big portion of my portfolio in Google. I'd love to cut that down, honestly, just because I think it is a little bit too much in the advertising business when you account for some of the other stocks I hold as well. But I would like to cut this down to maybe 15 to 20% and then reinvest that in a couple other companies, which we'll talk about. Amazon, about 16% of my portfolio right now. Amazon, I think, is a really good company. And most people have it just for the cloud business. Like most big investors are only investing in it because of the cloud business itself, because it is highly profitable. But they kind of hate the retail business. But I think the retail business is basically a loss leader. And the traditional sense of a loss leader is that you actually lose money on it. I don't think that they probably lose that much money. I think it's basically break even. It's kind of an inefficient business, but they do that to get you into the ecosystem. They do that to spread Amazon to I want to say billions of households, maybe hundreds of millions of households. They do that to get you in the Prime business. They get that for the advertising. The advertising part of their business is one of the most profitable parts of their business, and it's still growing very quickly, in the 20% range per year still, and it's highly, highly profitable. Their revenue growth is still substantial too. This is an update for the newest quarter, but you can see $149 billion for the fourth quarter of 2022, as opposed to $137 billion for 2021. So even after COVID, they're still growing 10%, give or take, a year over year. And then you can see third quarter, 127 versus 110. So 10 to 15% each quarter they're growing from the year before. And they're still back and forth on free cash flow. Basically, they just reinvest in their business like mad. And their shares outstanding have been tapering off. So like a lot of these big tech companies, they're starting to cut back on their share dilution. And I think they'll actually probably buy back some shares at some point as well. You can also see annually, they have good return on capital employed, 14%. Not as good as some of these other businesses, but they are pretty efficient when it comes to returning capital to shareholders by growing their business. Return on capital employed, basically $1 in, how much return can you get on that? They are spending a lot on CapEx, so that is something to consider when you're looking at their free cash flow and you see, negative $16 billion. Well, they spent $64 billion on CapEx. So if you just spent $5 billion instead of 63, well, then you'd have a $45 billion free cash flow, which would be massive. They're still spending a lot in their business, and they did say that they're going to switch up and stop building so much or stop spending so much money on fulfillment facilities. And I think that is smart. A lot of them aren't even filled up, as I understand now. There's one by us that's in a big city. There's no one working at it, and it's the biggest building that I've ever seen pretty much, and there's no one working at it. So they're going to spend more on, I think it was AI and cloud computing. So we'll have to see how that goes. This is also up a lot. It fell down to $83, now up to $105. And it was up to 122 after their earnings, now 105, because some people said that the CFO said the AWS segment was going to grow at a slower pace, and investors did not want to hear that. It is a highly profitable company if they wanted it to be. If they wanted to turn on the profitability spigot, they could do that, and they could have, $40-50 billion worth of free cash flow, but they are reinvesting in their business. They don't really care, and this has been their goal from the beginning is basically, hey, grow the business as quickly as possible, reinvest in the business so we don't have to pay taxes, and continue to grow it over and over and over again. I mean, if you had bought it 10 years ago, they would be at $74 billion worth of revenue. Now they're at $500 billion. So almost, an 8x over 10 years in revenue? That's insane growth. Now it slowed down a little bit, 2021 to 2022, but they're still growing significantly for a company this big, almost the number one revenue company in the world, I think right behind Walmart. So huge growth there still. Now I'm going to try to move a little bit faster because I am talking a lot on each of these companies. Let's go into the next one here. We have VOO. So I just hold an index fund. I think VOO is great. They pay about 1.6% dividend yield, 1.5%, and it just holds some of the largest companies. I'd like to bump this up to 20 to 25%, honestly, and continue to raise that. Now, of course, I think a lot of these companies are undervalued too. So if one goes up versus another, like let's say Google all of a sudden unveils their AI and they go up to 30%, that might be when I start trimming it. But VOO, I don't see myself trimming this position. I've been adding to VOO more than just about any company recently, just because I think that I don't have enough VOO just to kind of weather some of the storms. And I would like to have more of it too, just for that nice dividend yield that is really low risk. Apple, 2.6% of my portfolio. Apple's just such a great company. And I was buying the majority of the Apple that I bought was back when it was about 125 to 135, right in here, and last year too. It's up 36% this year, and it's at $170. It just continues to get more and more expensive. It's at a forward PE of 25, though, which honestly, I don't think is terrible for Apple. But the thing is, it's near all-time highs on the price chart. So I've been adding to it. I'd love to add more if we see any kind of weakness, but we just rarely see weakness. I mean, it was 182 back in 2022, right at the beginning. Now it's basically been sideways for, a year and 4 months. So I'd love to pick up more Apple. Such a great ecosystem, such high free cash flow, $110 billion. But it is a $2.66 trillion market cap. They do pay a dividend, but it's not very significant. They have been just buying back shares. They have been growing their dividend, so that is good, about 5% or so a year. Not anything massive, but it does help if you want a dividend growth portfolio. Return on capital employed, just insane, 60%. But I also think that they don't necessarily reinvest as much in the business. So high return on capital employed is great, but if they don't actually employ that much capital, it's really easy to show a high return on capital employed. A lot of their money is just going to their shares outstanding and to their dividend. You can see that they do have a decent amount of debt too, but they have so much free cash flow, it doesn't really matter. I mean, their net debt is about negative 50 billion, but they could pay that off in 2 quarters. So don't really worry about that. So Apple's great. I would love to add more to it. That's one of the top companies I'd like to add more to. So if we see, Amazon or Google or Tesla spike up in price to really high levels, I'd love to add more to my Apple position. Microsoft, also another company that I'd like to add more to. It's just continuously moving up in price. And you can see here, $307 per share, not close to the all-time high, I believe. The all-time high was 340-ish. So I guess it's approaching. It's about 10% off. A great company. It continues to grow revenue. When we look, there's only about 1 year where it fell down in revenue over the last 20 years. Just consistent growth. If we look here, the last 10 years, average growth rate of 10% on revenue. EBITDA, let's take a look at that. Only a couple years that had negative EBITDA growth. 15% over the last 10 years, 15% annually. Free cash flow is growing massively too. Not as profitable quite in free cash flow as Apple. It's about 50%, but still 8.3% free cash flow growth. It's a little bit more expensive than Apple at 27 forward PE, and it commands that kind of premium because it is such a great company. I mean, they continue to buy back shares, continue to pay growing dividends. Dividend growth is around 9.3% over the last 10 years, so 9.3% a year. So the dividend yield is about 0.9%, but if you bought it now, it'd probably be 1% in a year. Like the blanking on the name of it, but the dividend yield cost, or the yield on cost. Expenses are going up. Research and development is growing steadily, as you can see, from 21 billion basically to 24.5 billion. Sales and marketing, 22 billion. CapEx, 24 billion. Their Azure business has also been growing recently, which is really one of the main drivers. And this is such a sticky business. again, I just love to add more to it. Cash, 104 billion, net debt, 50 billion, or debt 54 billion. So net is 50 billion. And they have so much free cash flow. One of the best balance sheets in the world. Would love to add more to this. They may be buying a large company soon, which is why they have so much cash sitting around. Now, one company I don't hold on this list is Berkshire Hathaway. That's another company I wouldn't mind adding to if it ever gets to a reasonable valuation, which I'm not saying that's unreasonable now, but it's just not really that attractive when I look at some other companies too. Would love to add to that too. Just companies I don't have to worry about as much. So that way, if I ever do want to take a couple steps away from monitoring my portfolio pretty much every day and adding every week, I could just relax for a couple months and not really have to worry about the companies. And I have made that shift over the last year or two to really doing more of that, where I could just buy companies and not worry that some big catalyst is going to blow up in a bad way. Just companies that are going to continue to grow. They have strong pricing power, that are highly profitable, that have good growth drivers. The next company is Meta. This is a company I've actually been trimming down a lot this year because it has made such a big run. I bought a lot towards the end of last year, but you can see that they had a lot of problems at the beginning of the year, and a lot of people were worried about them. They were actually in the $90 range, maybe $80 range at the very bottom, and then they've been spiking up. They're up almost 100% on the year. Revenue has started to look a little bit better. You can see that they had a little bit of growth over the last year. Not very significant anymore, though. I think their business is highly profitable when they want to turn on that profit spigot. But they are spending so much money. They still have a huge headcount. So their R&D did go down recently, about 0.4 billion, but they're still spending $9 billion in a quarter on research and development when their free cash flow is $7 billion. So they could almost double this, which I think in some people's minds is really good. But I think their business is largely at full scale. They still have some growth, but it's just not the company that it was years ago when it was becoming much more profitable and much larger. Right now they have a couple businesses that reach billions of people, and I don't know if they're going to be able to find another company that's going to do that they can buy, or if they're going to be able to really go into any other big driver of growth compared to Tesla, where they have multiple S curves where they could grow massively. Meta's like on the end of the S curve for what they have. Texas Roadhouse is another company that I own, and I've been adding more to over this year. TXRH. Texas Roadhouse, just a food company, but it has really good growth. So when you look at this annually, just really consistent revenue growth, 12.3% a year, kind of a compounder, as some people like to say. You can see over the last 10 years, just consistent growth in price. Of course, there have been some times where it fell, like COVID and like 2022, but these were great prices to be buying in. Basically going down to the $70 mark. I did pick some up around 80 to 100, I believe it was. Now it's at 110. Revenue growth, consistent. EBITDA growth, consistent. Free cash flow growth, consistent. Dividend hikes of 16% a year, and it pays 2%. So I was buying this around, like I said, $80, $90. Dividend yield was 2.5% to 3%, and they grow 15, 16% a year. They have a return on capital employed that's pretty high. It's much above that kind of that mark that you're looking for, 8 to 10%. It's at 17%. And they just consistently buy back shares, pay dividends, continue to grow EBITDA and net income. Same store growth continues up, and it's at a free cash flow yield of 3.5% at a forward PE of 20, which when you compare that to something like Chipotle, I don't know Chipotle's ticker, but CMG, they're trading at 35.4%, and they have pretty similar charts here. I mean, revenue growth's 12%. Dividend looks like they just paid it 1 year, but a pretty similar growth trajectory. Return on capital employed of 19% versus 17%. It seems very similar in the type of business it is. Texas Roadhouse is a little bit more expensive, I suppose, than Chipotle, but still similar businesses in similar industries or the same industry. Growth is pretty similar. and yet it is a much higher premium. So I really like Texas Roadhouse and will be continuing to buy more of it at opportune times. Next company, Vici. I should move a little bit faster. A lot of people have heard about this company over the last year. A dividend payer, real estate investment trust from Las Vegas, continues to grow dividends 10% a year. It has some funky graphs here because it is a little bit newer, and also it's a REIT, so they buy companies or buy buildings. They take on debt to finance these, so that's why their debt's so high. But overall, a pretty good growth company when it comes to real estate investment trust. It pays a huge dividend, 4.75%. They're really focused on Vegas, which is a very growing city. A lot of people are there right now. I've been hearing crazy stories about how busy it is, and they own some of the most iconic properties in Vegas. So companies can't move out because they're some of the largest companies in Vegas, gambling companies, and they're known for staying in specific properties. This is kind of a good thing for them too, because they can take on a bunch of cash, or they can get a bunch of cash if they sell their property over to Vici, and then Vici can make some constant income. And they have inflation baked into most of the contracts, so that way if inflation goes up, Vici gets paid more and more. So really sticky business in a very fast growing city. So I think they'll continue to do well as well. And I have been trying to shift more of my Vici shares to retirement accounts, just because then you don't have to pay as much in taxes. Of course, consult a tax professional, but consider that when you're investing in REITs. SCHD, I'm not even going to pull that one up, but it basically just holds a lot of dividend paying stocks. It's a good diversification. It's in my dividend portfolio. Realty Income, another real estate investment trust, just to provide some extra exposure, but I might just switch that over to Vici, honestly. Starbucks, great company at a little bit of an expensive price now compared to where it was recently. I believe it's around 115. Might add more though if it falls. S&P Global Rating Agency, and this is a pretty great company too. Let me look it up. A lot of people haven't really heard about it too much, but you can see significant growth, revenue growth, free cash flow growth, dividend growth. They have high return on capital employed, 38%, 40%. Don't know why this is so low in 2022. I'm guessing some kind of data error. Same thing with the shares outstanding. But great company. This is a company behind S&P 500. So S&P Global has basically the rights over S&P 500, and a lot of these index funds pay them money. So even if a lot of people start turning to individual stock, or turn away from individual stock investing and start buying indices, they'll make money from that. And they're also a rating agency, so when a lot of companies go public, they make money from that too. UNP is a railroad company, really strong growth. Now, kind of mismanaged recently, but they're basically a monopoly or duopoly with some of the other railroad industries. Unless Tesla has their full self-driving and they start using semi-trucks, and a lot of people use them, there's not really a cheaper way of getting products across the U.S. And if Tesla does that, well, I have a very large position in Tesla, so I'll be happy. MicroStrategy, 1.6%. I have a lot of Bitcoin and crypto specifically, but MicroStrategy is a nice thing because you can put it in retirement accounts. Cash, I have about 1% cash. That I have more. This is just what's sitting in some of my accounts now that I want to account for, but I have more that's outside of these accounts. That's just in bank accounts, which is where I keep most of my cash. I don't really keep any cash in my accounts themselves. This is just a little extra from an options portfolio. Then CleanSpark, I have about 0.5% of my portfolio in CleanSpark. Wouldn't mind adding more to that at some point if it falls down, but most of my money that's in crypto is actually in the pure form of crypto. So I'd rather hold Bitcoin for the most part than miners, because miners are just riskier. Then Netflix, I added a position to Netflix after their earnings because I do think that they are a solid company that is getting beaten down, or got beaten down a lot from their earnings, and I think it will continue to grow in the future. It's really the only profitable streaming company as of now, Obviously, some other companies have streaming as just part of their company, and they can kind of rely on their legacy business to fund that new streaming business. But Netflix already has a profitable streaming business, and it's really lean and mean. And I think Netflix will be here 50 years from now. Let me know your thoughts on these companies underneath the video, though. Let me know if there's anything you would add, or if I have something completely wrong, if I should take out a company, or if there's something I should add to. Thank you so much for watching. I appreciate it, and I'll see you in the next video. Bye.